What's going on, everyone? Welcome to another episode of the Remote Real Estate Investor. I'm Michael Album, and today I'm joined by my co-host,
Emil Shore.
And today we're going to be talking about a topic that I've been getting a lot of questions about inside the Rusuck Academy, and that's commercial mortgages and what do I do if I've hit my 10 loan limit on the conventional side. So let's get into it. Emil, what's going on, my man?
Hey, dude. How you doing?
Hanging in there, traveling, on the road, hanging out. No complaints. How you doing?
As always. I'm good, man. Just ready to talk real estate and loans, conventional, commercial. I think this is an interesting one, actually, because I think it's when you're new and you hear about like the 10 loan limit, you're like, what do I do after that? I remember being like, what am I going to do after that? And then you learn a little bit more about commercial and you're like, oh, this isn't that complicated, and it's really not that much more expensive from an interest rate perspective.
Yeah. It's so funny. I hear the same thing all the time from folks like, oh, what do I do? Like, I can't get started investing in real estate because what if I hit my 10 loan limit? It's like, yeah, well, we'll worry about that after you have 10 properties. Like, that's a great problem to have. Right. And by that point, most people figure out an alternative source of financing anyhow. So I just, let's start by talking about what a conventional mortgage is, kind of how it works, what the mechanics are of it, and then we can transition to talking about commercial mortgage. So, Emil, give me the breakdown of what a conventional mortgage looks like and sounds like, and what some of the terms are.
Sure, and please correct me if I incorrectly say any of this. So, conventional mortgages, your typical bank will loan these out. They are usually government backed. They come in 30 or 15 year amortization, meaning that is the life of the loan and the repayment period. What else am I forgetting here? You pay do we want to get into like the nitty gritty? Like most of your interest is paid up front and then more of your principal is paid on the back end. So it's not like a linear payment through those 30 or 15 years, but
no, I think that's perfect, man. So most people, when they go to their bank, they're going to see their 15-year fixed, 30-year fixed. They also have ARMs. A lot of banks will offer ARMs, which just is an acronym for adjustable rate mortgage. And you'll usually see that as a 5-1 or a 7-1 or a 10-1. And that first number is just how long the interest rate is fixed for. So in a 5-1 situation, it's fixed for 5 years, and then it adjusts once per year, every year, is what that 5-1 means. And that amortization can either be a 15-year or a 30-year, I believe, but check with your lender to see what options they have. And just like Emil mentioned, it's like how many pieces the loan is cut into is the amortization. So 15 years, you're going to pay 15 years by 12 months, or 30 years is going to be 30 years by 12 months. So on a shorter mortgage, on a 15-year mortgage, your payments are going to be higher for the same interest rate because you're just paying it back sooner. So let's shift gears here, Emil, a little bit and talk about commercial mortgages. I can't recall, do you have any yet?
I don't. I've only used, since I've only bought single family and 2 to 4 unit, I've been okay using conventional 30-year fixed.
Awesome. And that's a great point too, that like for everyone listening that might not be familiar, 2 to 4 units, you can still use conventional financing. So you can still go to your standard bank, get a mortgage on that property. Commercial is anything 5 units or greater. And this can take the form of this can look like a couple different things. This could be 5 single family homes purchased as part of a portfolio that you want to put onto a single note or a single mortgage, as opposed to having them on each individual 5 mortgages. So you can go commercial that way, or it could be a 5-unit building, a small apartment building, small multifamily. So commercial mortgages work a little bit differently. And one of the biggest differences is that the lender is going to look to the property or the asset to carry the debt, as opposed to you as the borrower. So anyone who's gotten a conventional mortgage, whether for their primary or for an investment property, is likely familiar with the full cavity search that the mortgage process is. And so they want to see tax returns and income statements and bank statements and who your mailman was at your last 3 properties and all that sort of thing. So it's just like, it's so intense, which is great. And a big part of that came about after 2008. People said, hey, we have to get stricter with our lending requirements so that people aren't defaulting on their mortgages, causing this whole massive tailspin. So the lending institutions really tightened up, and I think that's a good thing. People who shouldn't be getting mortgages are having a harder time getting them. Now, the commercial industry is a little bit different because those loans tend to not be backed by the federal government, like Emil was talking about. Fannie and Freddie are 2 government agencies that back and often purchase these mortgages. The commercial world is a little bit different. And so a lot of these mortgages are actually kept on the books of the lender. And so that's often referred to as a portfolio lender. The mortgages stay on their portfolio, are a part of their portfolio. And so because of that, they don't have the same lending requirements that conventional lenders do. And so they can actually look to the property or to the asset itself to say, okay, this is what the taxes are, this is what the insurance are, this is how much the debt service is or the mortgage payment is. That means there's this much left over for you. Okay, the property works, the numbers work. And what they're often looking for is what's called a debt service coverage ratio, or a DSCR of some number. A lot of banks use 1.2 or 1.25, and they want to see, okay, the debt is $1,000. I want to see that the property brings in at least $1,200 because that's going to be a 1.2% debt service coverage ratio. So they're taking the fraction of how much the property brings in as compared to how much debt you have on the property. They're also going to look at what the taxes and insurance and other expenses are and underwrite it accordingly. But that's in essence what they're looking at. They are going to be concerned with you as a borrower. They make sure that you have money in your account, that you're not in the middle of a bankruptcy, and that you haven't defaulted on a bunch of other loans. But you also have what's called non-recourse loans, which are basically where the lender is saying, okay, if you default on the loan, we're not coming to you as an individual. We are going to just take the property back and we'll deal with it afterwards. Versus full recourse is, hey, you just don't make your mortgage payment. That lender is going to take the property back and they're going to come after you to get their full payment back.
I have a question for you, Michael. When are you usually eligible for non-recourse? Because who wouldn't want non-recourse?
Yeah. So some lenders offer it at a certain dollar amount for the loan. That's their threshold, like over $1 million is non-recourse. Or you can potentially buy it. And so you can pay a higher interest rate to have it be non-recourse. Some lenders will offer that. And so it's a really good question to ask lenders as you're having the conversation with them is, hey, is this recourse or non-recourse? Oh, if they tell you it's recourse, ask them if there's an option for non-recourse and see what they say. Because you're right. It's given the choice, non-recourse is definitely better. I have the vast majority of my loans are full recourse. I'm a personal guarantor on these loans, even though they're made to my LLCs. The loan is in the name of the LLC. I'm a personal guarantor on these. But I'm in the business of paying back my loans. So I'm less concerned with the non-recourse part. But again, all things being equal, I'm choosing non-recourse 10 days out of 10.
Did you choose recourse because you got better rates and for all the reasons you meant, you're just getting it's cheaper, I guess, for you?
It's cheaper, and it really wasn't an option for a lot of the loan sizes that I was taking on.
Okay.
I just now took out a loan on a commercial property, on a triple net property that I own with my two brothers, and that was non-recourse. Half of it's non-recourse, half of it's full recourse, and then similar on another loan that I'm working on for cash out refi. Up to X dollars is full recourse, and everything above that was non-recourse. Okay. So I'm getting into that kind of sphere now.
Very cool.
Yeah, it's a pretty cool thing. And then we did a webinar last night for Roofstock Academy, and somebody asked a question about getting portfolio loans out of their self-directed IRAs. And I'm pretty sure that all of the lending done in the self-directed space is non-recourse, but definitely check with those lenders who are lending there as well. Getting back to it, so the terms are just going to be a little bit different on your commercial property. The amortization period is going to be a little bit shorter. It's typically going to be 20 or 25 years. And the fixed term of the interest rate is kind of like an arm. And so that first number you see in a commercial loan statement, it could be a 525. That first number 5 is the fixed period, just like with an arm. And then the second number, the 25, is the amortization period. So 520, 525, 1020, 720. These are all very common mortgage terms and amortization periods. And again, it's just important to keep in mind that the shorter the amortization period, the more expensive or the larger the monthly loan payment. So I'll just give everybody an example here. On a $250,000 property, you put down your 20%, 50 grand, you have a mortgage of 200,000. At a 4% interest rate on a 30-year amortization, your payment's $954. If we shorten the amortization period to 25 years, your payment goes up to $1,055. So about an extra $100 a month by shortening the amortization period by 5 years. So again, just something to be aware of as you're running your analysis. Make sure that you're getting your amortization periods right, because I know a lot of folks are using a 30-year calculator. Make sure that you adjust that accordingly if you are going commercial or you are using a different amortization period.
Aren't there commercial loans where it's amortized over 25 years, but there's a balloon payment at the end of 10, where you basically have to refinance or pay the whole loan or something.
Yes, super good point, Emil. So you want to make very sure that you understand how your loan operates at the end of that fixed interest rate period. So oftentimes what you'll see is the loan, let's call it a 525, at the end of that 5-year period is just going to reset. It's going to reset for another 5 years at whatever the prevailing interest rate is. And most lenders will say it will never go below your current rate. So let's say you're at 4%, 5-year fixed for over 25 years. And in 5 years, now rates are at 6%. Well, your loan is just going to reset at 6% for the next 5 years. If rates are down at 3%, your loan is going to stay at that 4%. So you might have to refinance, go through that whole rigmarole process to get a better rate. But you could also talk to your lender about, hey, rates are dropping. Let's talk about a loan modification kind of a thing, which is something that I've done in the past. And that's really one of the benefits of a portfolio lender is that they keep the loan on their books. And so they can be a lot more flexible with what they're doing with their loans, as opposed to the conventional world that's serviced by a servicer. There's really not a whole lot they can do to change it without going through the full refinance process. So what, Emil, you're referencing is if the alternative type of loan is one that has a balloon payment at the end. And so if we go back to our 525, 5-year fixed over 25-year amortization period, at the end of that 5-year period, you might actually owe the entire remaining balance of that loan. Now, you've only paid it off over 5 years, so you're only 20% through that loan. And the majority of the interest is paid at the front. And so you're paying very little principal at the beginning of the life of that loan. So let's say on that $200,000 loan, after 5 years, let's say you paid off 10 grand. I just picked a number. So you would essentially owe $190,000 still on that mortgage, and that's due at the end of that 5-year period. So what it forces you to do is you got to go refinance. Unless you had a windfall, you had some cash lying around, you can go pay off that full balance. But what most people do is they end up refinancing a little bit 30, 60, 90 days before the maturity of that loan. And then they'll go get new debt, pay off the old existing debt. Now they'll have a new mortgage, hopefully at better terms. Maybe it was even with some cash out if you're in an appreciating market. So people tend to recycle this over and over again. Now, something that's super important to keep in mind is the cost of capital, or the cost of doing a refinance or doing a loan. Most lenders are going to charge origination points, their title and escrow fees. And so personally, I love locking in the longest term rates, or longest term loans I can get. Because if it costs you $5,000 to do a loan, and you're doing that every 5 years, that can start to add up pretty quickly. And so even if I have to take a slightly higher rate on the interest rate, but I get to lock it in for 10 years, I can calculate out, okay, if I'm paying an extra $50, $75 a month on the mortgage because I take a higher rate, but I'm saving $5,000 every 5 years by not refinancing, that's a pretty big win in my book. So definitely be strategic and look at the math and the numbers behind what type of mortgage you're getting, conventional versus commercial, and also what the physical cost of capital or the cost of closing those mortgages are. Because again, it might sound counterintuitive, but sometimes taking a higher rate for a different type of product could be the right move for you.
Yeah, especially if you feel like interest rates are never going to be lower than they are now. Why not take as long of that rate, even though it's higher, it'll still, you may think it may be lower than 5-10 years from now. So lock it in longer.
Yeah. Lock it in for as long as you can. I mean, that's something that I spent the last 6 months doing is I actually found a lender that would do 30-year fixed on multifamily commercial properties. Wow. So 5 units plus. And so the rate is like 4.25, 4.3, which yes, is higher than what it would be for a 5-year fixed or a 10-year fixed on a 20 or 25-year AM, but I'm locking it in for 30 years. And so that additional 0.25% or 0.5% that I'm paying over the life of the loan, I'm happy to for the assuredness that the rate is never going to move. And at some point along that 30-year time horizon, I'm pretty sure I'm going to be comfortable and patting myself on the back for locking in a 4.25 on commercial multifamily. Something else to be cognizant of is, like I was talking about, the portfolio lender. So asking these lenders, hey, are you the one who's going to be servicing the loan? Do you keep it on your books or do you sell it? Because there is still a secondary market for commercial loans. It's just usually not Fannie and Freddie. So I was working with a commercial lender and a portfolio lender that kept everything on their books. Back in 2018, I think, I did a cash out refinance with them. I bought a property all cash. I turned around 30 days later and did a cash out refinance for 70% of the purchase price, and then used that cash to do a lot of the rehab. And I've talked about this on prior episodes, but I did that so I could get the purchase price down by using all cash, and then just turned around and refinanced a bunch of my cash out to then go do the rehab on the property. And that worked out really well. And so at the end of the day, it was basically a financed purchase for me. And the purchase price was lower than it would have been had I gone in originally with financing. So that's a strategy that I really like using. So when I got that refinance, the rate was 4.99, and that was a 10-year fixed over a 25-year amortization. And the rate was fine at the time, like 4.99. That was a decent rate. But a year, maybe 6 months, 9 months, fast forward, and rates had come down quite a bit. And at this time, I was traveling internationally with my wife for the better part of a year. And so I remember distinctly, like I was in Costa Rica and I called my lender and I was like, hey, rates have dropped a lot. What can you do for me? He goes, oh, let me see what I can do. He goes, we can drop your rate to 3.25 for $1,200. And I was like, yes, let's do that. So literally I signed 2 papers while in Costa Rica, scanned it back to my lender, and he was able to adjust my rate. And the payback on that, what I saved in finance charges compared to that $1,200 was like a 3 or 4 month payback. So after that 3 or 4 months, I was making more money and saving more money than I was originally. So I was like, yeah, this is a massive win. So if you can find those portfolio lenders, they can often be your best ally, and they can be really flexible with their mortgages. And I think asking them how their process works, do they ever do loan modifications? What does the process look like? Really getting a good insight into the commercial lending space and commercial lenders, specific commercial lenders, is really going to behoove you. And someone on the webinar last night asked, hey, should I go develop relationships with commercial lenders now? I'm only using conventional lenders. I think you should be doing both in tandem and in parallel, is developing relationships with commercial lenders, because at some point you will likely need them. And so have great relationships with your conventional lenders, be talking to commercial lenders, and by the time you are ready and need them, hopefully everyone's going to be primed and aware of your situation and aware of what it is you're trying to do. And that just makes that transition so much easier, as opposed to, shoot, I've hit my loan limit or my debt to income limit. I can't get any more loans. Now I got this great property though. I got to go scramble to figure out the financing. I think do it in tandem, do it in parallel, and you'll thank yourself. Your future self will thank your past self.
I know this could be like a full episode, but if you had to summarize in 30 to 60 seconds, how do you go about finding commercial lenders? Like, where's a good place for people to start? Yeah,
talk to your existing lenders, see if they have a commercial lending department. There are some banks out there that do. And so you might already be aware of them. Other than that, I would ask for references. So from your local agents, local property managers, local vendors, any other investors investing in the area. And as part of the Roofstock Academy, we have a vendor discussion channel in our Slack thread, and people are talking all the time. Hey, who do you use for lending in this space? Who do you use for lending in this space? And it's amazing. I got some incredible recommendations. Emil, I know you did too.
Yeah.
So it's an amazing community. So check out different communities, online forums, see who people are talking a lot about. The good lenders tend to be talked about pretty regularly. And if you can't find that those fruits of your labor don't yield any results, I think that's a sentence, that's a saying, online, just look at, hey, commercial lenders in Kansas City, commercial lenders in whatever market you're in, and see who pops up, and just start cold calling folks and start talking to them. Part of the webinar last night, we showcased some of the Roofstock Academy resources that we have, and we have interview templates and questionnaires for folks. And so we showcased our one about lenders, interviewing lenders specifically, and also property managers. But we have this great 7-page questionnaire and interview template to interview lenders to help you get an understanding of, okay, what are their pros, what are their cons, what types of questions should I be asking, especially if I'm brand new to the commercial space. So come check it out. It could be helpful, roofstockacademy.com. But there is definitely conversations and legwork to be done on the front end. Don't just choose the first one that you meet.
Solid.
Thanks so much, everyone, for listening. Hopefully that was valuable. And again, even if you're not someone that's taking advantage of commercial loans right now, but you think you might be, definitely go start having those conversations. Go start reaching out to folks and just learn a little bit more about the landscape. It will definitely behoove you for when you are ready, for when you are there. So as always, if you like the episode, feel free to leave us a rating or a review. We love hearing from everyone, as well as future episode topics and suggestions. We look forward to seeing you on the next one. Happy investing.
Happy investing.